So the next topic that we are going to learn is the specific ISA of the risk assessment is ISA 315 risk assessment. Now this was revised in 2019 because ISAs and IFRS always focuses on keeping up to the trend. So any new changes are always kept on updated. So this particular ISA, what it says is that what the auditor should do, like what kind of procedures auditor should perform in order to identify and assess the risk of material misstatements due to fraud or error at the financial statement as well as assertion levels. So these are ISAs 315 suggests the process or procedures the auditor need to establish to identify and assess the risk of material misstatement at a financial statement level and assertion level. So at financial statement level, what did we learn during the last topic? Financial statement level means going concern, right? Those are all financial statement related items. Fraud aspects or transactions that would affect multiple accounts of financial statement or financial statement level. Assertion level are particular to specific accounts like internal controls and things like that. Revenue accounts, revenue assets, etc. are called assertion level. Assertions are the, you would have learned this in your AA topic. Assertions are the characteristics of financial statement. You would have heard the term like occurrence. You would have heard the term like the term called as ACCA Cooper. So ACCA Cooper talks about accuracy, classification, cutoff, valuation, allocation, valuation, again classification, then occurrence, presentation and disclosure, existence, rights and obligation. So all the assertions that could impact, which characterize a transaction for a profit or loss and financial position, are called as assertion levels. I have given a summary of the various assertions as part of the reading material in the app. Please do read it before you watch this video. It's very important, and because it's a summary of what we learned in AA, I don't want to explain that again. But we will be learning it or covering it again in 7th chapter. So once you read that, you will get a fair refresher of what is the assertions that we are talking about. So we need to assess a risk as an auditor. We need to assess the risk which could impact the financial statement as a whole, which means multiple assertions and etc., as well as specific assertions of the financial statement as well we need to assess. As per ISA 315, and this is again, we need to design and implement appropriate responses for the assessed risk of material misstatement, which we will be learning in the next topic. So as we discussed, just let's talk about what is the risk of material misstatement at both these levels, like the financial statement level and the assertion level. We discussed like the financial statement level risks are primarily, losses, cash flow issue that could indicate a risk of going concern. Poor information, client systems are very poor, they do not maintain the records very properly, or they do not have systems and it's all on a manual basis. Integrity of the management, fraud risk, all these are part of the risk that could affect multiple areas of financial statement. So risk of material misstatement at the financial statement level are those risks that relate to the entire financial statement and could affect many assertions, not just one but many assertions. The auditor therefore determines the impact of such risk and designs the suitable responses. So what he's going to do is he's going to design specific responses for these risk of material misstatement, which could impact the multiple areas of financial statement and create specific responses. So the financial statement level risk that it could occur are: number one, operating losses and cash flow related problems. Operating losses and cash flow related problems. Now, this operating losses and cash flow related problems could lead to something that is called as going concern. The impact on financial statement because of the operating losses and cash flow statement are nothing but doubt over the going concern. So doubt over the appropriateness of continuing to adopt the going concern basis of accounting, which could lead to restatement of the financial statement affecting all assertions. So we have learned in financial reporting that financial statements are prepared on the basis of a going concern basis. What does that mean? It means that the entity, going concern means the entity continues to exist for an unlimited period of time. So when we prepare on a going concern basis, we use the concepts called as accrual concepts and things like that. And we put the, assets and then will be equal to equity plus liability. That's what the criteria classification we will do. That's how the going concern basis is prepared. So when the company is having or incurring operating losses and cash flow problems, then there are two things that will come to the mind of the. So then there are two things that will come to the mind of an auditor. What are they? Let's look at that. So we are going to learn, we are learning here is ACCA 315. Now what we are learning specifically is risk of material misstatement at financial statement level. So when there is a going concern issue, so when there is like operating losses or cash flow issues, then what will happen is that two things will happen. One is, there will be significant doubt over going concern. So that will be called as uncertainty of going concern. Now this uncertainty of going concern, what the company have to do is they have to disclose. So disclose in financial statement in notes to accounts. So notes. So disclose the uncertainty over going concern in financial statements notes. Then if the other situation that could happen, that is called as the entity is non-going concern. So which is the entity is non-going concern. So if the entity is non-going concern, then the FS have to be prepared. The basis of preparation should be breakup basis. So what is breakup basis? Like the way they report, way they calculate certain numbers, everything will change. To give you an example, non-current assets, you cannot use revaluation model or cost model. You will have to use what is specifically mentioned in IFRS 5, which is assets held for sale. Like fair value less cost to disposal at the time when we are saying that it's going to be a non-going concern. Inventory have to be valued at fair values. The amount that you have to repay have to be shown as repayable. Government grants might be repayable, right? Whatever the amounts of receivable, you should show only at the net receivable amount, like the bad debts have to be removed, like that. So when the company is non-going concern, the entire basis of the financial statement will change. But at the same time, if it is going concern, but still the company is having losses or cash flow issue, it will lead to a doubt of going concern, which we call it as uncertainty of going concern. Uncertainty of going concern says that you have to disclose it in the financial statement in notes. Now, as per the requirement of requirement of ACCA, so as per the ACCA says that the going concern assessment have to be done by the management for a period covering 12 months starting from the date of reporting period. So which means, let us say for example, our current year end is 31st December 2021. The going concern assessment have to be done on or before till the period 31st December 2022. So till the period of 12 months by the management, the going concern assessment have to be done. going concern assessment have to be done for a period of exactly 12 months. So this is the requirement of the ESA. So when it comes to going concern, such a risk are there where the management might not be doing the assessment properly, where the assessment is not done clearly, or the basis of going concern itself is wrong. They're saying it's going concern, but it could be non-going concern. There could be uncertainty of going concern, and they are not doing the disclosures very well. All these could be lead to the problems. The next one is called as the client's information systems and assessed as poor. So lack of poor internal controls, which could lead to where the material misstatements are affecting the accounting records at all the assertions. So the entire information system is poor, where they are using, there are errors in the system they use, which could lead to the data being corrupted at all parts of the financial statement. That's called as client's poor financial statement. Then concerns raised about the integrity of the management. Now, when there is integrity of the management, what happens is that, the management themselves might actually do something fraudulent activities. And there could be weak control environment, which the auditors are working for in the client, which could lead to be skeptical about the quality of the representation. So how they are preparing the financial statement itself is a question mark, because it could lead to a weak control environment and management's intentions and integrity are very poor. And the final part is increased risk of fraud at the financial statement level. So fraud of this nature could lead to manipulation of the financial statement, which could affect all the assertions. So if there is a fraud, then the question will also be whether the fraud is only so much that we have identified, or there is more amount of fraud which we have unidentified or undetected by the management. So we have to be more skeptical, where we need to identify whether the fraud is something that is affecting the entire management, the entire financial statement, and it could affect the multiple areas as well. So if there is increased risk of fraud, where there is manipulation done by either the management or the appropriate employees, then the question will be, the auditors will be more skeptical as if whether the fraud is only what they have detected, or are there unidentified fraud which the management is unaware of. So clearly any of these financial statement risks could be considered more specific terms when assessing the risk of material misstatement at the assertion level. So even we have written down the financial statement level risk, the same risk could be affecting specific assertions as well. So during that time when we are assessing the risk of material misstatement at specific assertions, we will consider this risk again. So as a practice of auditor will write down all the risk that he might face with the client and create necessary responses, because for all the risk he might just do the procedures which he have written in the responses. If the risk is categorized low, he just have to do X amount of procedures. If it is risk is categorized as significant, he have to do additional procedures to reduce the risk to an acceptable level. And then we will learn the next topic, which is risk of material misstatement at an assertion level. Okay. So as I told you, the risk of material misstatement at assertion level are divided into two parts, which is inherent risk and then the control risk. So we learned what is inherent risk, we learned what is control risk. Inherent risk is relating to the susceptibility of any assertion that the specific account has some issues even before we start the audit. Like the moment we get the financial statement, there is troubles or issues. So let's understand now what is inherent risk and control risk just a bit more in detail. So as we discussed, inherent risk is the susceptibility of an assertion to any form of misstatement, which varies and will therefore sit on what is known as a spectrum of inherent risk, which the auditor assesses in terms of likelihood and magnitude. The assessed risk of material misstatement that sit towards the higher end of the spectrum are considered to be significant risk. So, as we told, inherent risk are the risk which the auditor will face even before he starts the audit. So, the moment he gets the financial statement could have certain risk of material misstatement. Like there could be errors in the financial statement. That is called as inherent risk. The inherent risk of an assertion to any form of misstatement varies and will therefore sit on what is known as a spectrum of risk, which the auditor assesses in terms of likelihood and impact, likelihood and magnitude. So let's quickly understand what is spectrum of inherent risk. Spectrum of inherent risk requires professional judgment by the auditor when determining both likelihood and magnitude, which would expressed by either qualitative or quantitative terms by reference to the nature, size and complex of the audit entity. So spectrum of audit risk is where the risk would depend upon the nature, size and complexity of the audit entity. If an audit entity or a client is from a specific industry, then the specific industry entity would have certain kind of a risk, would carry a certain kind of a risk. That is called as a spectrum, that falls under the spectrum of inherent risk. And therefore the resulting combination of likelihood and magnitude is then evaluated, and higher it gets, the higher the assessment of inherent risk. The ISA points out for an assessment to be considered high, it does not require both likelihood and magnitude to be assessed as high. So the spectrum of inherent risk, to identify such issues or identify such risk, professional judgment is required. Like there could be certain transactions, or there could be certain dealings, or so there could be certain kind of an entity which can be considered risky, but an auditor needs experience if he wants to identify that kind of risk. That is called a spectrum of risk. And therefore, when the professional judgment which is required to identify a risk increases over and over and again, where it goes to the higher end, it will be classified as a significant risk. And such significant risk require more auditor's attention and will therefore be prioritized. I can give you a very simple transaction in significant risk. You would have learned in SBR financial instrument, and definitely provision for such financial instruments. The provision for financial instruments or financial asset within financial instrument is based on an expected credit loss model, where there are different levels. Okay, certain kind of I would say level 1, level 2, level 3, and based on the levels the provision will depend. So those expected, if a particular company has an ECL kind of a provision, then that particular ECL category will be considered as a significant risk, because classification of any financial asset as level 1, level 2 or level 3 is completely certain kind of judgment is involved. Judgment means I'm not saying, oh, you know what, you just take a random decision. No. Judgment involves looking into the information, checking whether the information makes sense, prioritizing and classifying the financial asset to the category, and discussion with the client based on the provision that will be created, because the provision will always be based on an expected percentage. That is called as judgment. So you have to take a certain decision based on the information. So that risk might be considered as a financial significant risk. And to give a simple example is banks. In a bank gives loans to their customers, and for bank, when they are giving loans to the customers, it is a financial asset for them. It's an investment for them, and the customers might not pay back, and hence the financial asset where they give loans should be classified as, should go through a ECL model, expected credit loss provision. And how do you classify certain assets as level 1, 2, 3? There are certain steps involved and professional judgment are taken, and hence that provision requires a lot of groundwork and information to be looked at, and hence that will be considered as a significant risk for a bank. Likewise, there are multiple risks which are associated. If there are lack of controls, or if there are, let's say for example, a transaction is considered to be risky in nature, it will be considered as significant risk. Certain entities, like to give an example, service entities, revenue could be a significant risk. To give an example, let's say education industry. Take a case of Byju's. What did they do? They booked something called as accelerated revenues. What is accelerated revenues? Let us say you take a course of Byju's. They book the revenue immediately. But the course will run for 6 months to 1 year. But they would say that the revenue was occurred for the current year, even though you are finishing up in the next year, finishing up the course in the next year. And as per revenue model, revenue should be recognized only when performance obligation is satisfied. Significant risk. Okay. So unless and specifically required by a separate ISA, the determination of a significant risk will be matter of a professional judgment. So if ISA says that this particular transaction will be considered as a significant risk, to give an example, related party transaction, then it will automatically fraud risk categories. If that's the way, then definitely it will be classified as a significant risk. Otherwise, identifying significant risk is a professional judgment. Should assertion level risk to be considered as have a pervasive effect on financial statement, they may be classified as a financial statement level of risk. So as I told you, the ECL provision, it might be impacting a bigger percentage of the assets of the banks. Why? Because banks might give, let's say, 1 crore loan, and if they give loans close to 1 crore to bad creditworthy customers, poor creditworthy customers or poor credit rating customers, then as per ECL they will be under level 3. So the provision will be close to 100%. So provision could be around 50 lakhs, 60 lakhs, 70 lakhs, or in fact sometimes it might be 100 lakh, 1 crore itself. So what will happen? That will be a pervasive amount because it's taking up a huge percentage of your financial statement. So then it will be considered as a financial statement level risk. Technically, maybe 1 or 2 accounts to be considered as financial statement level risk is very rare. But yeah, it could happen depending upon the client. We can never say it might not happen. The second is controlled risk assessment. So in terms of risk of material misstatement, we look at inherent risk assessment as well as controlled risk assessment. The controlled risk is the risk that the misstatements might not be prevented or detected by the internal controls of the company. The assessment of the controlled risk is supported by testing the operating effectiveness of the controls. So we check whether the controls are working fine. We take samples and look at it. We might also check if we have been auditing continuously the client. We might look at last year which accounts or which particular controls had deficiency. Current year, this will be the risk. And whenever the controls are considered, the auditor will need to differentiate between the controls. One is a direct control. What is a direct control? That are precise enough to address the risk of material misstatement at an assertion level. That is called as direct control. Second, indirect controls. Those that support the direct controls. So if there are direct controls, let's say for example, a maker checker. Someone posts a journal entry, another one checks it. If the person who posts the journal entry, it is not being reviewed by the superior, then it is a direct control. Because it definitely affects the misstatement directly. Indirect control are anything which is supporting this direct control. Right? Supporting this direct control. We don't have to go much in detail in this because it's not very much tested in AAA. So I'm just stopping here as a direct and indirect control. So fraud risk, in control risk, example is a fraud risk. If the controls are not working fine and if there are a lot of manual interventions, then that particular account could be classified as a fraud risk. I can remember one specific item is when I was auditing a bank. There were some revenue related entries, and revenue itself is considered as a significant risk. But what the client used to do is post some manual entries. The revenue was supposed to be an automated entry because bank interest receives and interest they pay. The moment the interest is due, the client will have to be paid and they can recognize revenue, right? Because if I given a loan for 3 months and after 3 months I can book for an interest. So the interest will become my revenue. That's what the bank work. So it's an automated entry. The moment the interest is due, automatically you will post an entry. Likewise, a customer takes a loan. The moment the customer, takes a loan, and the moment, the interest is due, after, he has used for 3 months, then definitely you can post an entry. But what they used to do is the client used to post some manual entries into this revenue. This interest, they used to do some adjustment manually. That is a fraud risk. It's considered as a significant risk because it is a fraud risk. So clearly, significant risk will require more auditors' attention and demand that responses are performed with greater urgency. Evidence to satisfy significant risk may need to be more persuasive. There may also need to be greater involvement with those charged with governance. So any significant risk we will specifically identify, and we will involve those charged with governance in a detailed manner. And significant risk may be considered as key audit matters as well. So significant risk are those matters which will be considered as key audit matters, which the auditors spend too much time auditing it, collecting evidences. For manufacturing companies, it could be inventory, or inventory related provisions could be a significant risk. For the bank, revenue was considered a significant risk and it was considered a fraud risk. Any risk which is considered as a fraud risk, where there are manual interventions, will automatically be a significant risk. All fraud risks are significant risk, but not all significant risks are fraud risk. Significant risk could occur also because of the nature of the transaction. Like as I told you, the ECL provision is a significant risk, but not necessarily that it could be a fraud risk. But revenue where the client is posting some manual entry is a fraud risk. Why? Because the person can post whatever entry he wants and he can inflate the revenue. But that's supposed to be not the case. It should be automated. That's a significant risk. Sorry, that's a fraud risk. So significant risk could impact due to the professional judgment, subjectivity, as well as the complexity by taking them into account. So as per ISA 315, the auditors, what they will do? The auditors will obtain evidences. So auditors will obtain evidence to number one, to identify and assess the risk of material misstatement. That's the number one thing he will do. Second, to design further audit procedures. So the auditor will firstly identify and assess the risk of material misstatement, and then he will design and further audit procedures. So the risk assessment procedures, how he can identify the risk of material misstatements will be based on the procedures that he will do. Now, what are the procedures he might do? The audit procedures the auditor will execute to identify such risk of material misstatement is through A, E, I, O and U. What is A, E, I, O, U? We would have learned this in AA. A, E, I, O, U. A is analytical procedures. E is inquiry. I is inspection. O is observation. And U is recalculation / reperformance. So the auditor will execute this AEIOU procedure to identify or collect information with respect to the audit risk associated with the company or the client. So A, as I told you, is analytical procedures. Analytical procedure is all about comparisons, right? He will compare it. He'll compare against prior years. He'll do ratio analysis. He'll compare it with, current year ratios with financial informations. He will compare it against financial versus non-financial, or will form under analytical procedures. Inquiry, he will talk to the client, he'll talk to the management, he'll talk to those charged with governance, he'll talk to the control department, he'll talk to people who are doing systems, etc. That is called as inquiry. Getting information by inquiring with the client. Inspection is all about, inspecting the documents. He will be studying the documents. He'll be studying the systems, collecting evidences by looking into the documents to see if there are any issues identified or if there are any deficiencies. Observation is watching. So if a person is doing a particular control, he will observe to see if the control is done properly, to see how the accountant is actually posting certain entries. That's called as observe. Recalculation or reperformance is based on, if it is a control, he will do a reperformance. Like he will perform the control to see, auditor will perform the control to see if there are any mistakes. Recalculation is where, he will recalculate it. Like for example, depreciation, whatever the client posts, he will recalculate it to see the calculations are coming out correctly. Additionally, also what the auditors will do is, he'll try to get information from other sources as well, such as acceptance and continuous procedures and discussions among the audit team themselves. Like acceptance and continuous procedures means KYC of the client. He will take information of the client and to see if the client is in a risky nature, which industry they are. That's one. Second, discussion among the audit team members. If he is new to this particular client, let's say I'm a new partner for this client, I will talk to the old partner, or I will talk to the previous year auditor to see to gather more information about the client. So all these risk assessment procedures that the auditor does, what he will do is that he will use these procedures to obtain an understanding about. So the risk assessment procedures, what he will do is that he will obtain, he will obtain an understanding of one, the entity, environment, the entity themselves, the environment or the surrounding in which the entity works, like their industry, their business model, their regulatory requirements, what are the measures used to internally and externally there to assess its financial performance, etc. Second, the financial reporting framework. So what are the policies that is used? What is the accounting policy they have used? Have they changed their accounting policy very recently, or is it consistent? Are they using the accounting policy that they are allowed to use in their specific industry or in their specific country? Third, the controls, the system of controls, system of internal controls. So if they will use these risk assessment procedures and obtain the understanding about these three factors, because if they obtain an understanding about these three factors, then it will help them to identify the risk associated with these three factors for the client. Because there could be, to give an example, an entity could be classified themselves as a high risk entity. Why? Because the entity could be in a specific type of a business, financial services, could be classified as a high risk. Industry, the banking industry, the regulation is so strong, so it could be high risk. Because if the auditor are auditing a banking company, then definitely the central bank of that country will very much interested in the auditors being on the performance of the audit. Second, if the company is actually going through a high amount of regulations, then the regulators will be very much interested to see who's auditing, how they are auditing, etc. Public limited companies, definitely the risk will be very high. Public interest entities or public limited companies, the risk will be very high. If they are using financial reporting framework IFRS, there are specific, IFRS standards which are a bit complicated, which could lead to inherent risk. And easily to understand is the system of controls. Based on the controls they are using, if there are controls are good, bad, the controls are not functioning very well or not functioning effectively, definitely it could lead to certain risk. So let's just talk now specifically about the system of control, because the other two I've already explained. The entity or auditor will obtain understanding to assess the risk based on the entity and its environment, and the financial reporting framework. So when it comes to the applicable financial reporting framework, the auditor will firstly focuses on certain high risk areas, like for example revenue recognition. What is for online retailers and resellers? Because for online, revenue recognition is a problem, because they might give like refunds or they might give return policies, which causes for the client to account for refund. Industry specific accounting principle and practices like loans held by bank, research and development in pharmaceutical industry are all high risk areas. Accounting for assets, liabilities and transactions in foreign currency, because foreign currency will require foreign exchange transactions, foreign exchange gain or loss. The third one talks about accounting for unusual or emerging issues, like cryptocurrency is a very good example of it. So in cryptocurrencies, how they account the cryptocurrencies, how do they account for it? That also is unusual. There is complexity involved, because the value of the cryptocurrency is changing very rapidly. And when it comes to the entity and its environment, it focuses on majorly the industry, the external factors they are working for, the nature of the entity, like the ownership, organization structure, what are their transactions and major balances, what are the accounting policies selected and how they are applied, and the measurement and review of its financial performance. Like if they are not financially doing well, going concern could be a risk. So that will call for a entity's risk itself. So if they are financially not doing well, the financial performance is poor, automatically going concern would be a risk. So these aspects we will look for. And when it comes to system of control, the system of control are divided into 5 components. Primarily 5 components. So there are 5 components in a system of control. What are they? The system of control, okay, I'm just going to write it down. The system of control, 5 components are: number 1, control environment; second, risk assessment; third, information systems; fourth, control activities; and fifth, control monitoring. So the control environment is relevant to the preparation of the financial statement. The control environment primarily focuses on how the management carries out their company. What is the culture of the company? What is the integrity values they carry out to their employees? If the management themselves are planning to do some fraudulent activities, then the control environment they are working is very poor. If the management does not have, implemented good systems, there is no IT system, good lack of poor systems are there, there are no controls, anybody can post any entry, etc., then the control environment they are working in is lacking a huge system of controls. The independence of those charged with governance and their oversight of the system of internal controls, like the board of directors. The board of directors, are they independent? The board of directors, are they separate from the management? There is a management and there is board of directors. And the board of directors should have, as you know, as per corporate governance, equal member of executive directors. Executive and non-executive directors. Non-executive directors should be independent. If they are not, then definitely the control environment is not good. Because the reason why non-executive directors are independent is to ensure that the control environment is appropriate. And there is good controls in the system. Assessment of authority and responsibility. Are they creating a level of authority and responsibility with respect to the controls? How competent individuals are attracted, developed and trained. How individuals are held responsibility for their, how individuals are held accountable for their responsibilities to the system, all called for the control environment. So the auditor, what he will do is he will evaluate whether the management has created and maintained a culture of honesty and ethical behavior, whether he has created a system of improper internal controls, and are there any deficiencies identified in the control environment that undermine the component of the system of internal controls. That's what he's trying to do in control environment. In risk assessment, the auditor is trying to assess the companies have they created a system where they know to assess their business risk. Are they identifying the business risk appropriately? Business risk identification. Business risk identification. Second, their significance and likelihood of their occurrence. Significance and likelihood of their occurrence. Third, address those risks. Address those risks. So, in risk assessment, the entity's risk assessment process in relation to the preparation of financial statements is what the auditor is concerned about. Whether the entity identifies the business risk relevant to the financial reporting. Are they, assessing the significance and likelihood of the, risk or occurrence or errors? And are they addressing, if the risk is coming up, are they addressing such risk, etc. is what the auditor is trying to identify. The third, information systems. With respect to information systems, the auditor is trying to understand the entity's information system. What are the system they use? How the information is generated in the system? How the accounting records are produced and recorded, and the flow of information is processed? How the system prepares the financial statements, including the relevant disclosures? What are the resources, including the IT environment related to above? How are they created? What are the resources that is used? The auditor, what they should do is they should understand how the systems which are relating to the preparation of financial statement are created, and are they communicated within the entity, those charged with governance, and with external parties. How the reporting of the information are going to within the entity, between those charged with governance and the external parties. Like, are their financial performance being shared within the management reporting systems? Are they shared to those charged with governance? Are their financial performance reported to the external parties? Is what is called as information related systems. In control activities, we are specifically identifying identifying the risk of material misstatement with respect to a specific levels of controls. The controls that access the significant risk. Let's say, for example, there is a significant assertion, like for example, revenue recognition, and how the management or the company addresses the revenue recognition. What are the controls over journal entries? Are they reviewing the controls before posting the entries? Is automated controls posted automatically, or are there any adjustments? How the auditor plans to test the operating effectiveness of this, operating effectiveness of these controls. All of those things, the control activities, the auditor will try to identify. The control activities are of two categories specifically. One is IT general controls. Second is IT application controls. IT general controls are examples like segregation of duties, authentication, authorization, provision of user accesses, limiting the accesses, restricting the physical access to the data, all form part of IT general controls. This will impact multiple systems, will apply to multiple systems, multiple or all systems or processes, like maker checker, reviewer, password protections. All of those will apply to all the systems. However, IT application is specific to the application, the specific application used for informations, used to process information. So to give you an example, what are the applications that is specific to a specific system that the company uses are called as IT application controls. And finally, the last point is about control monitoring. What is the entity's process to monitor all the controls or all the items that we discussed? Are the entities actually monitoring their control activities? Have they identified deficiencies? Do they have an internal auditor? Are the internal audit function reporting to those charged with governance? Internal audit function. Are they reporting to those charged with governance? All forms a part of the monitoring of the IT control systems. Is the entity diligent enough to ensure that the control, they want to ensure that they adapt to the control, they kind of identify the deficiencies in the control very well and adapt to the new controls and create new controls if there are any deficiencies, etc. All those are called as control monitoring. So as you noted, I'm not explaining very much detail. I'm just giving you a summary. I'm also attaching a specific reading material which will help you to understand this particular pointers in deeper. Just read this because it's not very detailedly tested, but it's very important for you to read.